Cocoa is the example for almost anything you want to say about trend following. I can come up with using cocoa as an example for almost any question you ask me. Profits, totally different subject than the losses. So the losses, really small. Profit fluctuations, really large. We're humans, and we really like a pat on the back and positive feedback from the market saying, you're a good person, you're doing well. There's a lot of things that go into trading, and you should do them all pretty well.
Hello, everyone, and welcome to the podcast. Before we get started, a quick reminder, the following is intended for educational purposes only and should not be considered trading or investment advice. My name is Ben Lichtenstein. Joining me is Jerry Parker. He's Chairman and Chief Executive Officer of Chesapeake Capital and Chesapeake Holding Company. Jerry, welcome. It's good to be back in front of the camera with you.
Yes, good to see you, Ben. Thanks for having me. And as you can see, I'm celebrating our big Lightning victory last night in Game 6. Unfortunately, there is going to be a Game 7, so we have to worry about tomorrow, but it was really fun last night.
Well, I keep thinking about, for the ticket holders and for the people that are paying for those expensive seats, I mean, having these overtime periods and the added, bonus is just like, it's such a thrill, and it's such a, I mean, what a way to just get your bang for your buck.
Oh, I don't know if it's safe to watch these games, especially if you have a heart condition. So I don't know. I would rather see a big blowout and have my team win. I'm not a big fan of good close games. What a great game that was. No, not unless we win.
I don't know. There's something about me. There's something that likes the close game. I was definitely on the edge of on my seat last night watching, and I'm not even a big diehard hockey fan by any means, but I've gotten into it thanks to Jerry, and I'm following the series very closely. That's for sure. So again, best of luck to the Bolts tomorrow night. Jerry, lots to cover. Let's get started right away. Last episode, we covered initiating trades. We talked about exiting trades. We answered the questions where we get in, when we get in, and we talked about why we get in. A lot of takeaways in that conversation. But for me, the biggest was that, simply put, you got to take every trade. It's essential that you do. But also what stood out, what stuck with me, is how the systematic approach, that rules-based approach to entries, it's so conducive to that bigger picture idea that every trade's treated the same, that they're all treated equally.
Yeah, every trade needs to be treated the same so we can pick up the sample size and trade everything the same way, and regardless of whether it's a long or a short, and whether it's a commodity or a stock, it doesn't really matter. This is one of the geniuses of this strategy, is to ensure how do we become create something that's more reliable, and that is strictly just by back testing lots and lots of over decades, many hundreds and hundreds of markets. And so this is definitely the way I've traded my entire career, not trying to fine tune things too much, but definitely relying upon that sample size. I mean, that was one of the biggest things we were taught back in the early 80s, was maximize that sample size. And the systems are longer term now versus 30, 40 years ago. So we're getting fewer trades. So the sample size and keeping the systems clean and with less clutter and less parameters is even more important now, because we're moving away from a larger sample size the more we have to go longer term.
You know, I kind of think of it, I was fishing the other day in the Sound, and I was wading way out. And as I came back, there was a guy throwing a cast net. You know, and I've talked to you how I think of it kind of as like this, you're throwing out this wide net, you know, and trying to capture or cast out, and in that's going to be one of these outliers, these big trades that develop. And as you say that, I kind of think about that cast net doesn't have small squares on the top of it and larger squares on the bottom of it, and the gill net captures fish, and every square is the same. right? To provide that uniform, that sample size as well, similar situation. And so I oftentimes kind of think of the two as I'm fishing, and it provides a lot of food for thought. And similarly to the trading floor, we used to have a saying, wash, rinse, repeat. If you made money in a very simple way, or if you did something that worked, it was like, hey, just do that again. Don't overthink it. Wash, rinse, repeat. It was simple. Sometimes simple things work.
That's easy to do, especially, but it becomes harder when you have dry periods where
Hmm.
there haven't been a lot of trends, and that's why I'm really always impressed by traders who keep doing what they're supposed to do and don't deviate when the times
Even
are
during the tough
tough.
times.
Yeah.
Yeah.
So I was just reading about a trader today who someone wrote an article trying to replicate their performance and basically saying, look, we tried our best, but what's really impressive about this person is the amount of losing periods that they suffered through without changing and deviating and losing confidence and doing that next trade. As many times when I first started out where I didn't do the next trade because I was not confident. I was building up losses. We take small losses, but those small losses can add up in a system that is in the best of times 40% profitable, but it can get a lot less profitable on a percentage basis. Sometimes 5 or 10% of the trades can be profitable, and that's
Mhm.
really, really difficult.
Hmm. Yeah, well, they say it's always darkest before the dawn, but I understand what you're saying. And so the question I have is, was he, you said you were impressed by him. Was he able to match that same performance, or you were impressed by the fact that even though he didn't match that performance, he kept on striving for it and kept being consistent in terms of his approach too?
He was definitely consistent in his approach, and he just waited for the good markets to show up and
Hmm.
didn't try to tinker around with things too
Hmm.
much. I think that's another thing that you want to be careful with is making changes in the middle of a drawdown or during a bad period as you're sort of like you said, building expectation things are going to get better because that's the way the markets kind of work. If it's hard, it's worth doing, and even if it's really hard, it's hard primarily because it has losing periods. And this person, I talk about 40% winning trades, but some people want their stop losses to be less optimal than that, and they want to keep those losses really small. So his reported percentage of winning trades was 25%. So so that is really difficult, psychologically difficult to beat your head against the wall and have 75% of the trades be losing trades. We're humans and we really like a pat on the back and positive feedback from the market saying, you're a good person, you're doing well. And just a one tick profit. Rich used to say, like a one tick profit. That's all we kind of want. Just make it one tick. And people would say, oh, you've heard of this cliche. One of Rich's big things was uh, proving cliches wrong, market um, cliches. One is don't let a profit turn into a loss. Just take a one tick profit, but you should not let a decent profit or any profit maybe turn into a loss. And the computer is like, oh, that's all wrong. Let your profits turn into losses. If the stop loss gets hit, it's a loss. And so you don't want to have this psychological human failing idea of, I don't like this, I don't like that. I have my ways that I don't really like. No one likes these things, but you just need to follow the rules and that are derived from the back test. And the back test will say, oh, more pain you can suffer, more psychological scarring you're willing to take, uh, that will lead you to a superior parameters and rules.
Yeah, it's definitely one of the first rules I was ever told. And when I think back to some of the trading, some of the rules that I learned initially on the trading floor, they were so wrong. One was you're only as good as your last trade. That was a famous one for so many years. It took me a while to shed that one. And then the other one is, like you just said, never let a winner turn into a loser. And just so off the mark. Now, again, a completely different approach, trying to take ticks in the pit versus the long term approach that you have. But um, Jerry, kind of sticking with that idea, and also the idea of a one tick winner, kind of makes me think about another saying we used to have on the trading floor, and along those same lines, you'd sometimes find yourself, what they say, eat like a canary and crap like an elephant. So you have to be careful of that sometimes, I think. Okay, Jerry, let's talk a little bit about back to kind of that idea of the clean entry logic or the sharpest filters, not having too many filters. The Aussie Turtles, a couple guys you've done a lot of work with, Adam Haverly and Richard Brennan, they say that you can have the cleanest entry logic, the sharpest filters, the most robust back test, but if your position sizing is off, nothing else will save you.
Well, I try to stay away from, trying to figure out what's the most important thing, or what's the one thing you must do, or I think it's better to think about, you should do them all. There's a lot of things that go into trading, and you should do them all pretty well. There's a lot of things that go into building a house, and you cannot be successful if you have a company that builds houses, but you only pay attention to what you consider to be the most important thing. When you move into a house, everything's important. So everything's important. Sizing the trades is important. And if you have any sort of weaknesses in your strategy, it's going to show up. And a lot of people do have weaknesses in their strategies relates to sizing. They don't really know how to do it the way that we were kind of taught, or they just use discretion. But I do think the CTA turtle sizing formulas are definitely important and help with trading quite a bit. Although I think a lot of people um, don't follow them correctly and add other features into that as well. I think there is a temptation to always try to find the strongest trades, the best trades, versus sizing everything equally. So that's another area where I think people say one thing and kind of sometimes do the other.
Hmm. Yeah, for me, it's super appealing. The sizing everything equally, strict rules-based approach to the entries, the exit. It's something that I've thrived on structure since. So, Jerry, we're not just going to talk about position sizing today. We'll also talk a little bit about risk stops and trailing stops. In terms of risk, I remember an old friend of mine, Martha. She used to say, in trading, if you can manage risk, if you can manage risk or your losses, basically, she was saying, if you can manage them properly, then everything else will take care of itself. I want to talk a little bit about risk then versus now. As a turtle trader trading for Richard 40 years ago, you guys took on a lot more risk. The exposure was a lot greater. I remember you telling a story at one point, you'd seen a 50% drawdown in one day.
That's right. Although just to go back a little, I would gently disagree with your friend on that statement. I don't think anything takes care of itself. No, I don't think that I would approach trading or anything that I was concerned about as just do this part here, everything else takes care of itself. It doesn't really take care of itself. In fact, I don't know if we've already talked about it, or we'll certainly talk about it in the future, that hardly anything is more important than letting profits run. So being amazing at risk control, optimal stop losses, and I mean, just the best, lots of diversification, lots of longs and shorts, and you're just doing everything is robust, and you're taking those small losses exactly the way you should, and you don't let profits run. Well, it didn't take care of itself, did it? Nope. I don't know why people say things like that, because that's not how life is built. Just do this one part, and you can sleep on the rest. Now, I'm sure she didn't mean sleep. I'm just saying, I don't know what people mean when they say these things. I so I could think of things that they could mean, which they probably don't. Well, I would just say, no, no, no. So nothing takes care of itself. We're going to cover everything, and everything is equally important. Or if it's not, let's just assume that it is. And over the rest of our career, let's try to improve all of these things. And that's another reason you don't want to have that mindset, because when's the last time you looked at everything else other than your risk? Oh, I never looked at it. Really? Oh, no, just for 50 years, I concentrated on risk and never on making the profits better. Well, I think that's ridiculous. Yeah, so I would not do that.
Well, no, no, no. I like that because it gets back to kind of the building the house example. I mean, if you're only focused on the windows and the doors and there's the electrical, there's the plumbing as well. I mean, it's not just one part. Like you said, it's not one thing, basically. But we were talking about risk and now versus then in terms of larger exposure that you guys had as turtles 40 years ago. Today, it's much less. I mean, you're talking about less than 1% of closed balance equity per trade, right?
Right. And, there's, we're, really, we're talking about there's at least two things to talk about in this area, which one is the stop loss,
Hmm.
and which we're going to keep close, 25 basis points, 50 basis points, 1% of our AUM is we're going to decide how much we want to risk per trade, per loss. And it's going to be a small number compared to maybe when I first started, but we're going to be very conservative, or, somewhat conservative to keep those losses small, depending upon your risk tolerance. But once that trade is a profit, and you brought up the idea that I lost 50% in one day, it was 50% of a massive open profit. So profits, totally different subject than the losses. So the losses, really small. Profit fluctuations, really, really large. And so you mean to tell me we're going to separate the wins and the losses and treat them incredibly different? Yes, exactly. We are. So if it's a loss, we're very cowardly. We don't want that loss to get larger. We don't want to wait around for it to come back. And that's, I think, a typical human response. With losses, we're very hopeful. We're hopeful that they're going to turn into profits, where we should be very afraid that the loss is going to get bigger.
Hmm.
With the profits, we're very afraid that the profit is going to go away, where we should be very hopeful that it's going to get bigger and bigger and be one of those 5 to 10% of our trades that really makes all of our money. So we have it just completely backwards. Now, modern CTAs don't look at it in that respect. It's a position. How are you going to manage this position? We're not going to have a bucket for losses, losing trades and winning trades. So this is traditional, classic caveman trend following.
Yeah, remove the discretion. But kind of like what you were talking about, you said you can decide how much to risk per loss. And you talk about choosing the amount of leverage and risk that you're comfortable with as an individual. I've heard you say before, it's the one piece of discretion or the one area where you feel like personality should influence your trading. You said it's the one place where you want personality to influence your trading.
Right. I think what you really want to do is do this back test and be aware that if it's hard to do, psychologically difficult to do, you should embrace that, and you should embrace just trading the best way possible. Not something that's going to make you feel good and go through an analysis of your personality, and you start dictating how you're going to trade, and because you don't really like big drawdowns, or you don't like losing trades, you don't like 40% winning trades. No, I would reject all of that and just try to find the best possible system. You can still have differences of opinion as to, well, I'm looking at sharp or I'm not looking at sharp, and but it's got to be based upon science, not your own personality. And
Hmm.
then once you have that, which you consider to be a well thought out plan that is based upon the back test and the math, then of course, if your personality is you're very conservative, you could trade smaller. If you're young and you're not that conservative and you want to try to make 30 or 40% and you want to trade larger, okay. But we're going to trade the same system theoretically under either scenario. I would build in some discretion there, like my personality, I'm conservative, my personality, I'm not conservative, versus building my personality into the system itself. You should hate it. You should not hate it, but you should really be difficult to do. So it could be, so it won't go away, and people will not find it enticing them to trade like you. And I think just the way kind of the world works, if it's hard, it's probably closer to being the right way to trade and trading unlike most other people who look for ease, comfort, and pleasure and smoothness. We don't want smoothness. We want profits, and we'll protect the capital with our stop losses, but we'll let the big profits gyrate quite a bit.
Yeah, we've talked about that, and that being that whole kind of premise. So along those lines, I remember talking or I'm sorry, reading how the Aussie turtles they talk about trend followers avoiding conviction-based overrides, along in that same thread, and talk about how it all starts with that initial fixed stop, using the ATR to normalize position size across diverse markets, anchored to closed balance equity. The fixed stop defines the risk. They say the trailing stop, that's where you allow profits to run, Jerry.
That's right. You gotta be disciplined and be willing to have loose pants. So loose pants is lots of scenarios that could take place in a trade, in a trend, a lot of different paths that market would take. And your system needs to be loose enough to where lots of things can happen and you still stay in the trade. And that's pretty important. And as over my past 40 years, longer term is better. There's more noise. There's more things that are causing the markets to go up and down. You know, you have a big drawdown, and then a few weeks later, the market goes back to new highs. So
Hmm.
recognizing that that sort of timing of the trend, what works best, that changes over time, and we're getting rewarded for being longer and longer term, which we're also getting rewarded for taking more pain and more drawdowns. It'd be much more fun to trade shorter term version and make the same amount of money because you wouldn't be stuck with the type of drawdowns we see now.
It makes me think of that example, that you pointed out to me one time, Tesla, I think it was the spring of last year, correct me if I'm wrong, April, May of last year, we had that huge pullback, and it traded right back down to, I think it was the 150-day low that you pointed out, and then it rallied right back up to make a new high, and if I'm correct, we actually just recently traded off or got right back down to that 150-day low again, and it has started to pull back off of that a little bit, almost exactly 1 year later, but, um the turtles had a stop on entry, but, how did they handle the trailing stop? Because I'd imagine they weren't waiting to see a 150-day pullback.
No, it was much shorter term, like the 20-day pullback, the 20-day
Uh-huh.
low. So I would like it if those type of parameters still worked, but they don't. My estimation, they don't work. So you have to be 100-day low, 150-day low, or some sort of long-term moving average crossover, or both. You could diversify your entries and exits with the Bollinger Bands and breakouts and moving averages and things like that. So there's a lot of those things would test out pretty similar, would have similar results. Yeah, so that's the turtles traded really large, hundreds, trying to make 100, 200% a year. But that's easier done with this type of trend following strategy that I know about if you're using shorter term entries and exits, which we don't use anymore. So it's turned into a little bit different game being longer term.
Yeah, I imagine, a little bit easier to sleep at night possibly with that longer term approach in terms of managing the trades and, just kind of, stomaching them. Sticking with that thought, position sizing, and again, kind of getting back to the Aussie turtle, something they said stuck out to me. They said that a robust sizing methodology is, they say, simple enough to execute without variance, which we talked about. Again, every trade being treated same. Scalable across dozens or hundreds of markets. So there's that widespread cast net that I talked about, and survivable through dry spells, whipsaws, and chaos. That's what you were talking about, in terms of um, being able to just kind of withstand those tough times.
Yeah, you can withstand tough times. Number one, you want to be able your primary reason way to withstand tough times. Well, you hope it's going to be that the system is really good and it's not too short term, not too long term. You're not getting too chopped up with the false breakouts and the consolidation periods. So you have lots of diversification across currencies, commodities, stocks, bonds, maybe some crypto, liquid, safe crypto futures, let's say. Um, but you could run into periods where the best trend following system is still going to lose money, and you may have to reduce your trading size and your risk across the positions, and for the future for a while, just to trade smaller for a while, and so you preserve that capital better. That's something you don't want to have to use too often. but
The
you may
cutback
have
rule you're
to.
talking
The
about.
cutback rule, you cut
Mhm.
back a little bit when you're losing. Nothing's going to beat that rule with effectiveness because it also allows you to reduce your risk and to keep doing this system just the way you're supposed to, without picking and choosing trades, skipping trades, or altering, using discretion on when to get out or get in. And so that's the strength of the cutback rule is continue to do the system in the same way just by reducing risk on each position in the future and the current positions for a while. You have to build these rules into your system, see what works for you.
Yeah, another one of those the safety measures. I feel like another component of the system that, stands up for itself so well, but combined with everything else, it really, really provides that enforced support. And another part of that, equally important, is again this idea that you have equal risk, unequal outcomes with every position. Right. Every position risks the same amount, but their payoffs are widely unequal, Jerry.
Over the short term, they're unequal. Over the long term, they're about the same.
Mm.
So I love that. I love that you get almost equal contribution to profit from all the different markets. Recently, all the time you're reading something about how 4% of the stocks on the buy and hold make all the money for the S&P or for an index. Well, in trend following, everything starts to contribute because all markets have these big trends and everything contributes to the portfolio over time, over a 10, 20, 30-year period. The British pound may make the same amount as cocoa, or if not, it's sort of trending in those directions, probably. So that's one of the great things to realize about trend following is that everything is, in the long run, the systems are about the different systems you trade are making about the same amount of money. The markets are all contributing about equally. The expectation per trade from a trend following philosophy is the expectation per trade is about the same for all the different markets. If not, realistically, looking back over history, it's probably trending in that direction. So over the next 100 years, we'll have a better indication. But that would be my guess is that no markets are superior to the others. It could be over short periods of time, but eventually, cocoa is the prime example. Cocoa is the example for almost anything you want to say about trend following. I can come up with using cocoa as an example for almost any question you ask me. But something that was not doing anything for 15 years, and all of a sudden it's one of the best trades of all time. That's why you can't skip. That's why you can't write markets off. It's okay to take markets out of your portfolio for whatever, if you're tired of it or if it's no longer liquid or whatever, but just keep it out. Don't keep bringing it in and out. That's the same as missing a trade. I didn't take British pound this time because I kicked it out of my portfolio, but now I'll put it back in my portfolio.
Hmm.
Dude, you just skip the trade. Don't
Mhm.
use semantics in the English language. You just use some use some discretion to get rid of the trade and try to convince yourself that you didn't skip it. Maybe you can have one of those. You can kick it out, kick the British pound out once, and then you can bring it back. But then after that, you got to keep it in there.
So let's talk about something that's very similar to that in terms of discretion or tinkering too much with the trade, and that is how Jerry trend followers look at, as you've put it or said in the past, they look at risk versus volatility and drawdowns on winning trades differently. Right. So you have risk in terms of the initial trade, and then you have volatility and you have drawdowns once you're in a winning trade. Now, I can remember you talking about how you don't look at volatility and drawdowns on profitable trades as anything other than volatility, but you look at risk as something different. The risk being what you're willing to risk on a certain trade. So again, we talked about it, whether it's 25, 50 basis points, you're concerned, you're very conservative with that. But with a big profit, you're much more liberal with that profit.
Right. So we want to limit those losses to small amount of our capital, and then through our back tests, we've learned that in order to maximize the profit, we will have trailing stops that are, have potential to give back a lot more than we're willing to risk on a losing trade. So where it's all based upon the back test. So if the back test came back and said, "Oh, don't use loose pants. Keep those trailing stops tight to the market." I mean, we would do it, right? So we're just basically following the back test. It says, well, if you really want to make a lot of money, you've got to be willing to give back a lot of that profit. And you could sort of totally, quote unquote, mishandle a certain individual trade, like crude. Let's say we give back all the profit in crude. I think in the back test, something like that might have happened, right? But the back test sums up all of those trades. It says, oh, yeah, you didn't handle quite a few of the trades optimally. Other people who used discretion or shorter term or a different rule that allowed you to preserve that profit, they made more money on that particular trade. But if you follow your uh, rules of allowing and using exits that allow a lot of the profit to go away before you get out, then you're going to make more money overall. And another thing that helps us is we don't really look at the Sharpe ratio, which does pay attention to volatility as the risk measurement. So it would cause you to do lots of different types of things, not just wait for the 100-day low, but use other things to smooth out those returns and to keep that Sharpe ratio high. So another advantage in this strategy is ignore Sharpe ratio because it's not proper risk evaluator in a strategy that has a non-normal distribution of trades. In other words, 5 or 10% of the trades look a lot different than the other 80 to 90% of the trades. It's not appropriate to use the Sharpe ratio in that regard, so we don't use it. It's really a different way of looking at things. And if it didn't continue to work, we wouldn't do it. Although another reason to do it, to ignore what we do and to focus on Sharpe is because clients would prefer that as well. So you really have to decide, are you going to trade correctly for yourself? Or is your trading going to reflect what you think is correct? And how much are you going to have to compromise to make clients feel better? So that's really another topic, but it really is something that you do have to sort of figure out for yourself when you trade this strategy.
So, Jerry, it's not so much you're saying that the Sharpe doesn't work. You're just saying that it's not the approach that you have, right? It's not the clean, true, classic trend following approach.
I don't think it's appropriate for long-term trend following to use the Sharpe ratio. Um, if you're letting profits run and playing for those outlier trades. And a lot of other CTAs do use the Sharpe, and they do things that makes those outlier trades smaller. So they kind of cut their profit short in some respect in order to maximize the Sharpe. The way we trade, I don't think that we don't allow the volatility of an open position to impact our risk of our capital because we don't include open trades profits in our capital base when we calculate our position sizes.
In terms of what we were talking about earlier, that closed trade equity.
Yeah.
Yeah. So, okay, real quick, Jerry, I was just sort of thinking to myself, when you talk short term and you talk long term, I feel like you have a completely different perspective than others. Talk to me. Short term for you is what, 1-2 years?
Oh, yeah, 1 or 2 years. But if you're talking about evaluating the results of a system or how each individual markets behaved using your trend following system, I mean, you got to look at 5 or 10 years in that regard.
Okay. In terms of that bigger picture sample size.
Yeah.
Okay. Well, I mean, as far as that goes, Jerry, that's one of the things that, I really feel like, I owe a big thanks to you for is just the ability or the kind of nudge or kick in the butt to watch and look at price through a different lens. Getting started out on the floor, everything is literally tick for tick. You're within the minutes and the seconds of every, the randomness, the chaos of every movement, every up and down move. And, I used to watch last week's highs. I'd watch monthly lows and highs but now focusing on these breakouts, these retracements, it's really, I mean, it's been a whole other experience. Again, like I was talking to you about the Tesla, looking at how price responds around that 150-day low or the 200-day low or the 100-day low you just mentioned. Um, and so that's for one, a real, I mean, just thanks to you for that. I always feel like my tendency is to revert back to the more, granular, more intraday, shorter time frame. So that's where my struggle's been, is just kind of like forcing myself and sticking with that longer term and not reverting back. It's kind of my, Achilles heel in some ways.
Yeah, I mean, people have this history with the markets and with their thought processes, and it's really just takes some time to get comfortable with essentially what the computer is telling you is the best way to trade. So you're like, I wish I could figure out the best way to trade.
Hmm.
I wish I had that ability to do that. Okay, we'll give you the ability to do it. Oh, I wish I liked it a lot more. So, like, wait a second, you were going to be happy if you just knew how to do it, right?
Hmm.
But now you know how to do it, but now you're not happy because it's not what you were anticipating. So,
Hmm.
I'm the
Hmm.
one who's advocated looking at weekly charts. And I mean, it was a struggle for me as well because look, sometimes you get these spike downs in gold and silver and cattle. Yeah, the cattle, that was a big spike down. You've had some reversals in crude recently. I mean, big bad days, $5 down, $9 down, and then it goes back and makes new highs. And so the back test picks up on this. It's saying, hey, look, if it didn't do that, we couldn't advise you to trade this way. The results would not look like they look. Give it the 100-day low, the 125-day low. And because the market, if it doesn't hit that, it has a tendency to not get there, but come right back to the highs and keep going. And then it's very powerful that you can maintain your current position, which was sized under a lower vol atmosphere. And then now, if you get out and it goes back to the highs, the volatility can be a lot higher, so the position's smaller. But if you're able to hold on to that initial position of a month or a year ago, when the volatility was really low, then you're just going to make more money, lots more money, just by holding on and not having to get out. So, but you're not going to be influenced by that because you're just going to follow that rule. Sometimes you're going to get bounced out of the 125-day low, and it's going to go up from there. So, bummer for you, right? And you're going to have to put the trade on, and you got out at the exact wrong time. That's going to happen. So you want to trade a couple different systems with a shorter term exit and a longer term exit, and it'll increase your odds of not maybe getting out of your entire position when things crash, or maybe you'll be happy that you got out of half quicker because the other exit got elected as well. So it's a benefit to trading multiple entries and exits in that regard, but it doesn't ensure that you're not going to get just nicked and get out of that trade at the exact wrong time. And the person trading the 175-day low, they're still in. So, you can't really worry about that too much.
Yeah, you can't worry about that too much. And I'm just to stick on this for another minute here, because that's again what the back test does. It basically tells you that you don't have to worry about that so much. It's done that for you, and it's already factored everything out. And now you just have to follow the trade and take the signals.
Right. And then you're saying, but is it going to be the future is the back test going to be a good indication of the future? Well, we don't really know that. All we know is our sample size was pretty significant.
Hmm.
And this is probably our best. The odds are in our favor, but it's not a guarantee. It's just, and over time we have done more research and we've noticed that things are changing a bit. So we're going to change the parameters a bit, become more longer term or whatever. And so maybe we're in the midst of a period where we should have changed our parameters. Uh, but that's why maybe you trade 4 different systems, so shorter to longer. Um, and maybe sometimes there'll be periods where the really short term stuff works a lot better than the longer term stuff. Is that here to stay? These are difficult questions and questions no one knows the answer to.
Yeah, I'd imagine they're a lot harder to find the answers to, though, if you're looking to do it in real time, versus taking that step back from Again, the intraday type approach towards trying to trade and looking at the bigger picture, you get a little bit more kind of clarity, I would think, and peace of mind in some ways to kind of think things through versus always feeling like you're, under the gun.
Yes, it's difficult to make sober changes in the midst of chaos.
Hey everyone, thanks for joining. Before we sign off, just a quick reminder, today's podcast was intended for educational purposes only and should not be considered investment advice.